Let's talk more about the Indian markets and its movers. Arun Leslie John is Chief Market Analyst at Century Financial and talks to us on the line from India. Arun, good to have you with us. You heard what Saurabh was talking about. That trade deal with the US is going to be a big trigger, a catalyst for the markets to move lower. You agree?
First of all, good morning and thank you for having me on the show. Yes, the trade deal with United States will be a big trigger for the markets going forward. If the India and United States, they're able to conclude a trade deal with minimal issues, the markets will be taking that in a big positive way, and hopefully there could be another leg up or another set of a rally which could take the Nifty higher to 26,000 levels.
Okay.
That can obviously be, a big trigger.
A big trigger. Our markets, do you think, are they ready for the reciprocal 26% tax if it arrives? Have they priced that into the markets?
Not really. At this point of time, the markets have not priced in the reciprocal tariffs. But having said that, it is worth noting that the impact of reciprocal tariffs on India when compared to other major global economies might be minimal, for the simple reason that India is not that much integrated with the global supply chains, maybe, for example, when compared to the more industrial economies of Southeast Asia or even China. So from that aspect, the impact would be minimal. India, as everyone knows, is more of a service sector economy rather than a manufacturing economy. Its merchandise trade, the global market share, the global trade share is still limited when compared to its service sector. So, the reciprocal tariff is still not priced in, but the impact might be not that huge as the fear is.
When you look at the resilience of Indian equities, managing to rise 7.9%, almost 8% in the first half of the year, holding on to that key 25,000 level. Do you see the Nifty hitting the 26,000 level in the second half? Is there momentum for that to happen?
There is momentum for that to happen. There is an uptick in the economic activity. The manufacturing PMIs as well as the service sector PMIs, they are showing improvement there. The rural demand is gradually beginning to pick up. So the fundamentals are improving at this point of time. So hopefully that should help the Nifty hit the 26K levels. A trade deal with United States and other major economies will be the icing on the cake.
Icing on the cake, certainly. RBI giving that bazooka of a rate cut, the bigger than expected 50 basis points rate cut, really giving the markets something to lean on to move higher. Could we see another rate cut from the RBI in the second half that could give the market some legs?
Further rate cuts from RBI might be limited, but I expect the RBI to be hold for the time being, even though the inflation has declined, giving the RBI some space to cut the rates. But RBI is likely to play it safe for now. So support, maybe there might be another 25 basis point rate cut, but that could be, it seems limited as of now. So support from the RBI, but RBI has released a huge amount of liquidity to the market. So the liquidity shortage in the economy is not there, which was previously. And RBI seems very supportive from a growth perspective. So support from the RBI is there, but further rate cuts might be limited.
When you look at the growth story in India, you can't deny the fact that there is one there. But the perception among global investors is that when you look at the markets, it is richly valued. Where do valuations stand in the Indian equity market? And can India continue to command that kind of premium?
I would like to think so. The valuation premium for India comes from the relatively higher GDP growth among the when compared to other major economies. So this year also, this financial year, the Indian economy, according to RBI, is likely to hit the 6.5% GDP growth rate. Now, if India is able to consistently hit that level of growth rate, some amount of valuation premium might be justified due to the scarcity of growth in other parts of the world. I mean, the economy is still $4 trillion, $4 trillion plus economy growing at 6.5% per annum. It's a good one. So India, should be able to attract global capital. Plus, there's a huge amount of domestic capital also, which is getting rerouted from the banking system to the stock markets, equities. That equity culture is still catching up. So there is a strong probability that the valuation premium in India will exist and can be sustained.
Arun, before we drill down to sectors, where does India stand in terms of global emerging market strategies? The Buy India, Sell China strategy, the narrative, is it still intact?
Not really. At this point of time, the Chinese equities also are gaining traction. There was a period of time when Indian equities enjoyed a lot of flows at the expense of China, but not anymore. The Chinese equities also seem to be on a strong wicket right now. Like India, if China also is able to conclude a trade deal with United States, it should be able to attract a lot of inflows. So, we are positive on China, but we don't think that India will be attracting flows at the expense of China, because especially the Chinese equity picture also is improving a lot.
Let's talk about sectors, and this is what Saurabh Mukherjee from Marcellus Investments Managers had to say about India's defense sector. Take a listen.
It's a crowded trade. It's at stretched valuations. Historically, it's been very difficult for the government of India to expedite big defense spending. There's a whole bunch of regulatory challenges in pushing through defense spending, and the valuations of these stocks are eye-watering. I think India will increase its defense spend. Recent hostilities with our neighbors up north are going to be a trigger for pushing up defense spend, but I suspect a lot of that money will go on arms purchased from abroad.
Arun, do you agree with Saurabh? You have a buy on the defense sector in India.
I agree with him that this is a crowded trade. But, if you look at the defense sector spending as a percentage of India's GDP, it has actually declined to about 1.6% of the GDP. So there is a lot of scope for the defense sector spending to expand in the coming year. The rising tensions, the recent sporting tensions with India's neighbor Pakistan means that India might be forced to increase the defense spending as a percentage of its GDP. So, and plus there is an added emphasis on local production of defense equipment. So the defense sector firms in India, they have strong tailwinds behind them. Additionally, we should also be taking a note of the fact that Europe also is increasing its defense spending due to the tensions inside Europe, or to balance Russia's economy, Russia's military might. By some estimates, Europe might be spending maybe upwards of 500 billion in the next 10 years. So a part of that defense orders also is likely to come to Indian firms also. South Korea also could be another major beneficiary. Partly due to the strategic concerns. So Indian defense firm, they are on a good ticket right now. We will continue to have a buy on dip approach to these firms.
And we've seen defense stocks trading right now, all moving to the upside, as you can see there, all in positive territory. Arun, Can I get your take on the banking sector? We had the RBI report that bank loans, the bank's bank loan ratio at multi-year lows. It's a good sign. It's supportive of the banking sector. You like the banks. And which of the banks do you like?
So I would prefer to go with the large cap banks in itself. I don't want to specify any names here. But I mean, for people who are looking for a sectoral play, banking ETFs in India can be a good choice. Now, again, why we remain bullish on banking? Again, the non-performing low assets, the banking balance sheets have been cleaned up. The NPAs have come to near a decade lows. So a lot of hard work that had to be done is already done. The sector seems poised to has the potential to give good capital returns for investors going forward.
The auto sector also is interesting. You like the auto sector particularly. How much of that is because of the EV story that's happening in India? At the same time, there are all these concerns about rare earths disrupting production, also competition coming from external EV players as well. Does this sector, in your mind, continue to remain challenged, or do you see bright spots in the auto sector?
So the auto sector has done well in the first half of the year, I mean, relatively speaking. So, I mean, again, it's a play on India's domestic economy. It's a play on India's domestic consumer. I mean, a play on the consumption story of India. So right now, India's per capita GDP is something like $2,900. So in the course of next 10 years, we expect it to rise substantially, maybe go above $5,000 level. So when this happens, there is a very good probability that the auto sector will be benefiting significantly. So among them, the electric vehicle theme seems very strong right now due to the continued government support. I mean, there are obviously external threats. Threats from imports are there. But given the Indian government's approach, they tend to play it safe. They tend to protect the domestic manufacturers by imposing high import duties. So we would like to believe that the domestic EV story, the domestic EV companies are likely to be insulated from the external threat. But yeah, the auto sector is likely to do well in terms of numbers going forward.
Arun, so much focus on China's AI story. We've been talking about this the whole morning. Is there an AI story going on in India right now that could offer pockets of investment opportunity? And in particular, I want to bring in this explosion in growth we're seeing in data centers and how that could benefit the real estate sector.
Unfortunately, at this point of time, I would say that that's a big shortcoming of the Indian market. There are not much listed players available to play the AI story. I mean, when China has companies like Alibaba, Baidu, or US has Alphabet, Microsoft, Amazon, or Nvidia on the hardware side. Unfortunately, there are no AI pure stories or pure plays available in India at this point of time. So that is certainly a big shortcoming of the Indian market. The economy or the stock market, even now, tends to be dominated more by the traditional companies with a smattering of some IT consultancy companies. So AI plays are limited.
What about energy? This is something where there's a lot of volatility surrounding crude, but refining margins are improving. Do you like this particular segment?
Yes, exactly. I mean, as you know, Reliance Industries is an obvious play on this particular sector from the private sector perspective. Then there are public sector enterprises also. The refining sector, I mean, in terms of price, we expect the oil prices to come down in spite of the regional tensions there. We would like to believe that the OPEC's decision to hike its output in the coming months could pressure oil prices, and that should indirectly boost the refining margins. So the refining space should be doing well in India going forward.
Arun, we were talking earlier with our earlier guest that, there could be some sort of fiscal stimulus and support coming in the second half of the year because the RBI has already front-loaded the 50 basis points rate cut, and much of it has now to be left in the court of the government with fiscal stimulus. Is there any sector that could benefit from any sort of fiscal pump priming that, as an investor, you could look into and get into?
Apart from the obvious push to infrastructure, which the government is already doing, we would like to take a look at the FMCG stocks. A part of the fiscal stimulus might be targeted at boosting the incomes in the rural areas. So FMCG sector, FMCG companies, they are a direct play on this theme. We would like to take a look at them.
All right. FMCG it is. Arun, great to talk to you today. Thank you so much for being with us. Arun Leslie John from Century Financial talking to us about Indian equities and markets for the second half of the year.